Welcome to Credit Bootcamp week 5. Can you guys believe that we are in week 5? I just think that is equally awesome as it is exciting, but also like really cool. Time is flying. I feel like time has flown by. I don't even understand or know, or nor can I account for the last 5 weeks. It kind of just went by. But today we are going to discuss one of my favorite topics, and I say things are my favorite topics every single week, and that's because like for that week, because I'm zoning in on one particular topic for the week's lesson, I'm reminded of how much I love whatever we're talking about, like that subject matter, right? However, credit cards is without a doubt my favorite credit topic to discuss. It's my favorite credit topic to discuss because I just love building credit. I love the art of building credit. I love the strategy behind obtaining and maintaining, and also increasing our credit limits and just our borrowing power in general. For the first 4 weeks of credit bootcamp, we sort of discussed the what some would call like the boring parts of credit, right? Like week 1, we discussed our credit reports. We did a breakdown of that. We identify each section, what belongs in each section and what does not. Week 2, we discussed our credit scores. What are the makings of our credit scores? What all goes into our credit scores? What determines how our credit scores behave? What does our credit scores respond to? And then in week 3, we discussed charge-offs. Yeah, week 3, we discussed charge-offs and collections. So we immediately went from our credit reports, our credit scores, to the derogatory accounts, right? We discussed the differences between the two, how to identify common errors amongst the two, and also how to challenge it, right? And then week 4, which was last week, we discussed the third party reporting agencies. What is their role within our financial lives? Are they as important as most people claim that they are? Do we need to pay attention to them? What areas of our lives do these third party reporting agencies affect? And what to do about them? Like, what can we do about them? What are our rights? And so that brings us to week 5, which is now. Week 5, we're going to discuss credit cards. So we basically didn't hit how to repair our credit, essentially, like how to. We discussed all the derogatory accounts and all of that, but up until now, we haven't discussed building credit in a strategic way, and also just a few pointers that I would like to give you guys on as you are pursuing the perfect credit profile or building credit. I definitely, without a doubt, could not leave out credit cards, right? And if you are a OG credit cousin, then you've heard multiple of these topics that we're going to discuss today, or these talking points, but it is nothing wrong with a refresher. Like, I think everybody needs a refresher every time I'm reviewing the topic for the week. I'm reminded of a lot of things that, may have just kind of passed through. Maybe I had forgotten about, and we consume a lot of information on a day-to-day basis. So it's never anything wrong with getting a refresher. So without further ado, we will get into this week's webinar, which, as I stated, oh, let me go back. We didn't skip the head. All right. So, without further ado, we are going to get into this week's presentation, which is credit cards. So, I wanted to focus on 3 main areas of credit card and just building credit in general. And those areas are how to obtain. So, we have obtaining, we have maintaining, and then we also have increasing, right? Those are 3 distinct paths that one will typically take as they are either building their credit, fixing their credit, or honestly both. Honestly both, right? I can't, those glasses are extremely blurry and I can't, okay? All right. So, we will discuss, as I stated, 3 distinct, actually 4. The presentation discusses 4 distinct paths on building credit and obtaining credit cards and building that perfect credit profile, right? The first one is obtaining, and then we have maintaining. So, how to obtain credit cards. What does it take in order to apply for a credit card, what are the things that you should do or look forward to doing prior to applying and obtaining your credit cards. And then we're going to discuss maintaining them. So after you get approved, then what? Like, what now? You got approved for this credit card. How do you properly pay the credit card bill to ensure that you aren't ruining the credit that you are building or have just built? How to position your credit profile in your credit cards in a way that would lead or aid to you increasing your credit limits, right? And just your overall borrowing ability in general. And also, what happens if you don't get approved? What happens if you get denied? Are there other options? Is there anything that you can do? What are your rights? What are your what then, right? And then increasing, of course. So four distinct paths that we will discuss today. And let me move my iPad over here so I can. All right. So section one, chapter one. I don't know. Well, section one, obtaining a credit card. So this section we're going to discuss before you apply, before you actually fill out that credit card application. What are the things that you need to be aware of? What are the things that you need to do or not do or avoid, right? In order to increase your chances of getting approved for that credit card. Are there anything? Well, let's see. Okay. So these are what I call the three big pivotal credit card application, either do's or don'ts, right? Make it or break it. These are literally make it or break it, right? These are the things also that I don't feel like most people pay attention to. They don't realize the importance of them. And I could not begin talking about credit cards before we before I'm sure that you guys understand the importance of all of these, right? And it looks like a lot, but I promise you it's not a lot. So let's go through them. So there are three main sections. One is the identity verification section, the banking relationship preparation, as well as the actual credit card application. Um, we wind it back a little bit. As I stated, this is before you apply. So if you already have credit cards, that's not to say that you won't find this information useful, because you will, especially if you plan on applying for other credit cards down the line or even increasing your current credit limits. So these are just fundamental things that for every lending application, whether you are applying for a loan, a credit card, etc., it doesn't have to necessarily just fall in line for credit cards, right? These are things that really does make a huge difference within your credit card application process. And I would just recommend that you start to be more cognizant of them as you are applying. Okay. So number one, identity verification. This one is so freaking important. What identity verification is, it's you ensuring before you apply for anything that there is consistency across your credit profile, your credit reports rather, from TransUnion, Equifax, and Experian, the big three, ensuring that there is consistency within your personal information. Why is this a big deal? It is a huge deal because when we apply for a credit card, any application that we do, and this goes for any company, right? Anytime we submit an application, what happens is that our application is ran through a server, like an application process server. That server has already predestined things that will make or break your credit application, right? Predestined red flags that will completely stop and halt the application process and automatically equal a denial for you, right? Like there are red flags that if this is on this person's credit profile, then application done, deny. And then on the flip side, there are certain things that as the computer is reading your credit application, that will either halt the process or honestly sometimes stop it. And an easy way to overcome the if you're a person that's used to getting that 7 to 10 day pending period, right? Like you apply for a credit card, you apply for Capital One, and then instead of approving you or denying you, They just say, "Hey, we are looking over your application and we will send you your results either in the mail or in your email within 7 to 10 business days." I call that the 7 to 10 day dread. Um Typically when you get that response, usually 90% of the time usually means that there is a mismatch within your identity, that either the company is pulling multiple credit profiles that fit the information that you input into the application, or they just cannot find a direct match based on the information that you entered versus the information that's already on your credit report. So, an easy way to bypass that, an easy way to make you look more as a borrower, right? To make you look more secure, to make you look just in general more put together and also more trustworthy, making sure that your personal information is consistent across all three bureaus helps a lot. It helps a lot because now you're not being stalled. Now you're not being stalled within the process. Typically, they will go ahead and process your application, and that just makes you look better. That just makes you look better. Now, addresses, and I said this when we were talking about personal information. I believe that was in like week 2. So if you are confused on how to make sure that your personal information is consistent across the bureaus, go back to week 2 and view that. Okay. Now, one area that's super important is your addresses, specifically the ones that you've reported in the last 3 years. All of the addresses on all three of your credit reports, right, that you have reported within the last 3 years, you need to ensure that they match one another. So if there is 10 or there is 5 addresses on TransUnion, but only 3 on Equifax, that just looks shady, right? Creditors want to see that you are consistent in every regard. I tell y'all that all the time. It's not necessarily just how consistent you are paying your credit cards or paying your other bills. No, every single thing on your credit report makes a difference, and every single thing on your credit report matters, even if it doesn't directly affect your score. It matters. It's there for a reason and it's used for a reason. Okay. Updating your addresses with all of your current creditors is so important, guys. This is something that's so slept on. No one ever talks about it, and it makes a difference. What does this mean? Every account that's open on your credit report right now, I need you before you apply for anything else. I need you to call all of your open accounts, all of your current creditors, and ensure that they are reporting the same address on your credit profile. There is nothing, and I repeat, nothing more of a red flag when it comes to your identity verification as your current creditors reporting different information. I don't think you guys understand how much of a red flag that is to lenders, because they're looking at it like, okay, it's understandable if old creditors are reporting, different information than what you have now, because maybe you've moved since then, maybe you have, gotten another job since that account has been closed. When it is your current creditors, meaning you are assumed to be in contact with those creditors because they are your current creditors, if they don't have correct information or misinformation, then you automatically don't look as trustworthy as you can. Right? And simply because to lenders, like I say, it's never how we look at it as consumers. Lenders look at that and say, well, you must don't care. You must don't care what person in their right mind would have an open account or have a current creditor and not ensure that that current creditor has their updated information. That is a red flag to lenders, because it's just like, okay, well, if you don't care, what happens when you move? Do we have to worry about you not updating us? You know what I'm saying? So it makes a difference. Ensure that all of your current creditors are reporting the same information. I cannot stress that enough. That directly not only impacts how much you get approved for, by the way, but if you get approved at all. If you get approved at all. Maintain the same phone number and email addresses across all applications. I have a email address that is specifically for credit applications. I don't use it for any other reason other than credit card applications, because I want it to be consistent across the board, right? It's one of those things that's nuanced. It seemingly does not matter, but what I've noticed is not only do I get a lot more pre-qualification offers specifically for that email address, because as you know, every time we apply for something, the information that we use is sold to like those third party agencies and things that we discussed last week. And along that, they sell it to other lenders, you know, just in case they want to like pre-approve us and pre-qualify us. The point is, you typically get the best offers, especially if you've been approved for like an account. The consumers, the reports that's been approved goes into one bucket, and then the consumers that's been denied for a credit application goes into another bucket, right? The approved list is sent to all of the best constituents of the company, right? So if it's Capital One, they're going to sell it to all the top companies. An approved credit profile means that you've already your credit profile has already, you know, been underwritten, you've already been approved. If one company will approve you, especially the top companies, right? And Capital One is considered a major company, a top company. So if Capital One approves you for a credit card, then there are a ton of other credit card companies, banks that will literally approve you just on a basis that Capital One has approved you recently. The same goes and more for American Express, Chase, City, all of that, right? So when you are on an approved list, you get the best offers, like offers that's not commercially available. More point. They offer things like more points. Even your current creditors, if they see that you've been approved for another, you know, credit card or whatever the case may be, maybe they weren't looking to give you an increase right then and there, but they see you recently just got approved. They're going to either try to increase your current limits or offer you another product. Okay, so I personally just use one email address and one phone number for all of those. Okay, ensure your legal name format consistently across accounts. The same, I pretty much already stated why that is important. Do not use any nicknames. I would avoid using abbreviations and things of that nature. I would try as best as I can to type my name the same exact way. I have a note in my phone where I just copy and paste it, right? It is my information and obviously I know it, but to ensure that everything is consistent every time, I just have my application information on one note and I just copy and paste. Okay. Then the second thing that I want to bring attention to is the banking relationship preparation. I don't think you guys know how important this is and how much of a difference this makes. Number one, before you apply for any credit card, whether it's your first time or you are getting your 10th card, it doesn't matter, right? The next time before you apply, ensure that you have a checking account with a national bank. Okay. National bank, unless it's like a small town like credit union or like a small town bank that, you know, maybe no one has heard of it other than like your local area, most banks count towards like a national bank, whether it's a credit union or like a Chase well, I can't think of any banks. Oh, Chase, Capital One has a bank account, um and all the other banks, Navy Federal and all of that. I just had a brain for it. Get a national bank account. I say 3 to 6 months. Simply because once you've had a checking account for at least 6 months, then that account isn't co- it's no longer considered new. Okay, so that's one thing that a lot of people don't pay attention to. The first 6 months of opening a bank account, you are essentially like on probation with that bank account, right? If it is being considered in your applications, it doesn't hold as much weight as it could, right? Once it graduates past 6 months, then that account, especially if it has not went negative, if you haven't overdrafted rather, then that account is considered a great contender for your borrowing power in terms of your what type of consumer you are. Can you maintain a bank account without overdrafting it for at least 6 months, right? And obviously the longer you go without a overdraft, the better. Specifically at 12 months. I didn't grab a picture of this, but you guys, hopefully you have your credit reports. If you scroll down on your credit reports now, on our credit reports, I don't know if you guys have noticed, but they have recently within the last 2 years added this on our credit profiles, like our actual big 3 credit reports, which was very, very surprising to me. They've added our banking information. Have anyone noticed that? Like you literally can scroll down. Um, Let me scoot up a little bit. Okay. You literally can scroll down on your credit reports and see how many times you have overdrafted within the last 12 months. Anyone who just recently got in their Metro 2 data report or your official credit reports from annualcreditreport.com, have you guys noticed that? And I'll see if I can bring up a copy really quick. I'll do it as I'm discussing the rest of this, because it's not that important, but it was very shocking when I seen it, because I'm like, wow, at first they did not have that on our credit reports, y'all. And I'm talking about, I say 24 months, but I looked at a credit report from last year and it didn't have it. So I don't know exactly when they added it. Specifically, I seen it on, what was it, TransUnion? I believe TransUnion. But yeah, that surprised me. But anyways, making sure that you have a national open checking account. Establish direct deposit or maintain a consistent positive balance. So this one, if you are a 9 to 5 worker, if you have a job and you get paid whatever frequency you get paid, right? Like every 2 weeks, every month, whatever, right? Um, Having direct deposit is always going to be a check towards having direct deposit is always going to be a point counted that you can retrieve, right? Like it's always going to be an extra point for you. A person with direct deposit, when it comes to banking and applying for credit cards, then they know that they can depend on you receiving money in this account every 2 weeks, or however, whatever the frequency of your payments are, your paychecks are. So that's always good. Now, for anyone who is maybe an entrepreneur, maybe you're a service worker, maybe your income is not as stable as a 9 to 5 worker. I always tell you guys this, and for presentation purposes, I want to repeat this. Lenders prefer 9 to 5 workers over entrepreneurs. Without a doubt, it doesn't matter about how much one makes versus the other. How much your income is, that really doesn't make a difference, because what lenders prefer over any and everything is stability and predictability. Okay, those are two things that every lender will look for. What is the likelihood of, or I'm sorry, can we predict when your next paycheck is going to come? Right, as an entrepreneur, as one knows, I'm sure, as you guys already know, uh it, things can be inconsistent, right? Like, while we are blessed with some seasons that may be consistent, it's still not predictable. They still can't count on that. That's why it's usually like year over year. Like, okay, you had a great year last year, but we really can't determine your next year based on last year. We can kind of make a guess. We can get a little comfortable, and the longer you've been doing it, the better that predictability score is. But they'll be more willing to give a 9 to 5 worker the benefit of the doubt. And that's simply because they can predict when they get paid. That's it, right? And another thing is, uh things like direct deposit. They know it's coming. They know it, you know what I'm saying? Like, they can count on it. They can count on it. So if you are an entrepreneur, I always recommend, just expert advice. I would recommend that you either have set up a regular deposit to your bank account. Even if you're a service worker, even if you get paid in cash, it is so good to build a predictable in uh uh it's so advisable, rather, to build a predictable income. Meaning, even if you get paid cash every single day, I would once a week or every 2 weeks make a deposit into my business bank account, or deposit into my bank account, right? If you are an entrepreneur, I would look into paying myself as a 9 to 5 worker there, and setting up direct deposit if you can, so that you have that normal consistency within your application. Um, Not only does it show how often you have overdrafted within the last year, I'm talking about on our credit reports now. Another thing that it shows is, do you have direct deposit set up? Direct deposit is automatically going to be checked if there is a if there is a consistent, rather, pattern over the course of 90 days. So 3 months, it takes 3 months in order to for the system to check that you have direct deposit. But it has to be consistent, and it has to be like on a normal schedule. Whether that's one every week, every Friday you get paid. You can pick the day, it doesn't matter, but it just needs to be consistent. So if you are a service worker, a cash worker, start to make regular deposits on the same day every week, or maybe 2 weeks. Okay. It just makes all of your application easier. I mean, it makes all of your applications more favorable to you, and just the process, it makes it easier. I promise you, you will not regret that. I had At this point, I think my score, it was just under 800, right? I was an entrepreneur for 2 years at that point. I had tax returns, I had all the things. There was always a hiccup between when I would do my credit applications. Either I would get that 7 to 10 day waiting period. I had the credit score to qualify, I had all of that. But then I started to do my regular deposits. I started to do my regular deposits into my bank account. And I did it for 3 months because I was advised that by a banker, actually. And when I tell you, ever since then, up until now, and this was a few years ago, I haven't gotten that pending message. I haven't gotten that pending message. And also what I haven't gotten is the income verification. Not that it would be an issue to do it, right? It's just annoying. I can't stand them. It's just like, okay, approve me or not. Like, yeah, I can send you all this, but I'm over it at this point. It's just too much. I don't want to feel like I'm applying for a home every single time I apply for a credit card. This is ridiculous, right? So when I started to set up those regular transaction patterns and ensure that my bank account was predictable, my income was predictable, it really changed the game. It really not only changed the game in terms of, again, not getting that message, but also the amounts that I was approved for, it absolutely increased because now everything is verified. Everything is verified. Okay. And then the last thing that I would say for the banking relationship, having a active checking, not only checking, but a savings account as well. As you guys know, whenever you do a credit card application, it literally will ask you, do you have a checking account? Do you have a savings account, or do you have a checking and savings account? Right? FYI, I don't know if you guys knew this, but if you do not choose that you have a checking and savings, then you automatically are getting knocked down a tier in terms of whatever you're going to get approved for, if anything. So if you are approved, whatever amount that you were approved for, you actually would have gotten more had you had a funded savings account and checking account. That automatically takes you down a notch, and you automatically don't qualify for the best offer, the best advertised offer that they're currently, whatever the company is that they're currently advertising. That requires a checking and saving. Okay. So if you only have, like, for example, like a cash app, right? Go back to last week and look at the third party reporting agencies episode, and then make sure you dispute your banking records. Challenge those so that you can open up a bank account. Look into second chance bank accounts. Like Capital One is a really good bank account for anyone who has been looking for a bank account and maybe cannot open it. Please have a checking and savings. A funded savings account only takes $10, guys. That's a hack. If you have at least $10 in a savings account, a national of any of the national banks, it is going to report it to the banking reporting agencies as a funded savings account. Funded. Because they don't know the exact amount that you have in your bank account. All they'll know is how many times you've overdrafted, or if the account is funded or unfunded. So overdrafted, funded, or unfunded. In order to trigger the funded, rating, you just need to have $10 in a savings account. Okay. Heck, please put $10 in a savings account at least a billing cycle prior to your next application, and just let it sit. Keep it there. I wouldn't even spend it. Just keep it there. And then apply for your whatever you want to apply for. Okay. And then now we're at the credit card application. First, I would always recommend to Google to see if whatever card you are applying for has some sort of pre-qualification tool, right? Like Capital One has them. American Express actually offers a pre-qual now. And what a pre-qualification is, or a soft pull, they don't gain access to your full credit report. They'll retrieve like a portion of your credit report, and they're able to see if you would be approved based on what they're seeing or not. So that if you are denied, you're not wasting an inquiry. It's a soft inquiry, so it will not affect your score, nor will your future lenders see that inquiry. That's only for your information. So always check to see if they have a pre-qualification, just because it'll save you an inquiry uh on either case, right? Chase has one, American Express has one, Discover has one, uh Navy, I'm not sure about the credit unions, but just Google it if you're not sure, and it should come up fairly easily. And then know the issuer's rules. So do not apply for example, a Chase card if you have opened more than 5 accounts within the last 24 months, right? So when I say know the issuer's rules, not a lot of banks have like these set in stone rules, but Chase is one that is widely known, right? Like if you they have it's called 5 and 24. If you've opened up more than 5 accounts, regardless of what type of accounts they are, they can be loans, they can be credit cards. If you've opened up more than 5 accounts within the last 24 months, regardless of how great your score is, Chase will deny you. There are only a few occasions on if they'll go, if they'll allow you to be approved if you have opened up more than 5 accounts, right? You got to get like a special approval. So for the most part, just understand that if you're applying for Chase and you've opened up more than 5 accounts, then you should not apply for right now. Wait until whatever account, your oldest account or your most recent account rather reaches 24 months and then apply for that. Okay. Okay. Now, as we are discussing obtaining credit cards, I always just want I always like to include this slide with any credit card presentation simply because I constantly hear, "Hey, Shonda, I cannot get approved for anything." Like I know you be, telling us how important it is to build credit and to have a credit card and how much of our credit scores we're leaving on the table when we don't have an open credit card and what we're doing to our borrowing power and all of that. I won't even bore you guys with that today because I feel like I've talked about that to nauseum, and I don't want to waste you guys' time. But just know that if you don't have a open credit card on your credit profile, then you aren't really building a good credit profile, right? Even if you have a good score, it doesn't matter. Your borrowing power certainly is suffering without a credit card simply because 30% of our credit scores are allocated for the use, our responsible use of a credit card. So when we choose to not have a credit card, whether you are freshly out of bankruptcy or just starting to build credit, the fastest and easiest and most efficient way to build credit and build a good solid credit foundation is obtaining a credit card. It just is what it is, okay? Um and never think that you can't get a credit card. There are credit cards for every single credit score, credit rating. If you have bad credit, meaning that you've had recent derogatory accounts within the last 18 to 24 months, whether that's collections, charge-offs, late payments, and things of that nature, then you may not get approved for the traditional starter cards, the traditional cards like, Capital One Platinum, Discover It, things of that nature, right? Or maybe you've got recently gotten denied for one of those cards. That is the telltale sign that your credit profile, there is something on your credit profile that is pushing you towards what's considered bad credit. Okay. So if you do have bad credit, then know that there are still options for you. Subprime cards. Subprime cards, they aren't, you don't think you're getting the razzle dazzle. They are literally subprime cards. They're stair steppers. They aren't meant for you to have for life, honestly. Nor are they meant for you to have. Yeah, you really can get rid of them after a year or two. You don't have to keep them because their whole entire point is to get you to the next level, is to get you to be approved for a traditional card, is to help you build credit on all three of the credit bureaus, build revolving credit or open credit for all three of the credit bureaus so that you can start to apply for better cards. So again, if you have bad credit, and you can't get approved for Capital Ones or Discover It's, then get a subprime card. Get a subprime card. There's nothing wrong with that. $200 card, $200 cards would do you just fine. That's all you need. But if you have less, for example, like a thin credit profile, or maybe you haven't built credit yet, or just starting to be established, getting established, then you typically can get a starter card, right? Pick two of them on the list. The same with subprime. If you have bad credit, pick two subprime cards. Start off with those. Obviously, you're not gonna, shop and ball till you fall on a subprime card nor a starter card. Though it's just not what they are for. Um, Understand that you need to be responsible in reporting those. I personally recommend that you don't carry a balance on a subprime card or a starter card because not only do they have high as HE double hockey stick interest rates, but also you have to look at it from a lender's point of view. If you have a $200 credit card, a $500 credit card, and you cannot be trusted to pay that back, why would they how would they be comfortable with approving you for $1,500, $2,000, $5,000, $10,000 if they see that you cannot properly maintain or handle a $200 credit card, right? That's just not the time, in my opinion, to be carrying over balances. If you can help it, if you can help it, nor is it the time to just be making your minimum payment. I don't recommend minimum payment on any credit card unless it's absolutely necessary, but especially not with these cards. You don't really have any wiggle room with those cards. Like, that's probation, right? I tell you guys all the time, when you have a subprime card or a starter card, you just think of it as you are in the probation period. You are trying it out. You are establishing yourself. You are proving yourself to your future lenders, because quite literally these are going to be the beacon, the foundation of your credit profile. Okay? So handle them with caution. I would only use them for small purchases that I can pay right back. And just get in that habit, because as you get to the mid tier, premium, or even the invitation only, that's going to be a habit that it will carry you through. Um, then after you have had a starter card for at least a year, so I recommend at least a year to 18 months, so 12 to 18 months after you have had a starter card, you typically are qualified for a mid tier card. A mid Honestly, nowadays, y'all, mid-tier and top tier, or AKA premium cards, they're honestly starting to mesh. I have noticed that recently, where these cards are approving pretty much the same credit profile, and really all they're requiring is that either it ranges between the companies, but it ranges between 12 months and 24 months of experience using a credit card. Obviously, showing and proving, that you know how to use a credit card. You understand what a credit card is. You routinely pay it back, reporting a low inch or not a low interest rate, a low utilization, and you can be trusted, right? So they're honestly starting to mesh. So yeah, just those cards are, I want to say unlimited, but it's like I'm a little I'm a little hesitant to say unlimited because that just sounds bizarre. But the point is, there is a cap for subprime cards and starter cards. But by the time you get to the mid tier list, the premium list, honestly, there are no limits to how many of those you can get. I personally would not recommend that you open up more than 3 within a calendar year, because at that point is just excessive. It's just not really recommended. But you can get as many of those as you want. Um, and then invitation only, yeah, you have to be invited. So yeah. And they primarily come through relationships. So as you are building credit and gaining access to higher credit limits, better credit cards, better rewards, all of that, a company will keep their eye on like the big spenders, right? Because obviously that's what they care about. The people who spend the most, they'll be invited to use those cards because they want to make more money, right? Like, it's all about money. Those cards, in my humble opinion, they aren't anything special. Like, if you actually look at the reward structures on those cards, they're insane to me. But I can understand it for, like, maybe, I don't know, like, maybe if you like 20 million, 20 million plus. Because at that point, it's just like, I don't even understand why I will ever want to pay $10,000 a month or $10,000 a year for an annual fee, like for the Centurion card. Absolutely not. Why would I do that? But anyways, I'm going to keep going. Okay. And I pretty much just explained this, but I also like to, so you guys know what you're getting into. Number one, like I said, subprime cards aren't the cards that you bought till you fall on. Those credit cards are tailored specifically for people with a negative credit history or recent derogatory accounts. They typically come with high interest. They typically come with secured lines, so you have to secure the credit lines, and they're usually known as dead end cards, meaning like they either do not graduate from their secured status to unsecured, nor do they grow. Like, that's not the card that you're going to get to try to increase your limit up to 1,000 plus, right? Nor should you put $1,000 on those cards. I cap it at 250 at the most, but 200 does the same job, right? um and again, like I stated, never get more than 2 subprime cards, never get more than 2 starter cards. And in fact, if you already have 2 subprime cards, I wouldn't get 2 starter cards. I would limit it to 1 if you can't get approved for a mid tier. And then starter cards are created for individuals with minimum or no credit history, thin credit profiles, not a lot of experience with credit cards, Most of them will require you to secure the line, start at $200. They typically are known for like their low limits. And they have a mildly limited growth. Their growth ceiling is pretty much right here, right? Like, so if they do grow, they're not usually, they usually cap out at around like that 1,500 mark, right? Some may go to, on average, so some may go to like 2,000, but they aren't typically the cars that's going to get into certainly not get into like the double digits, or whatever. Now, mid-tier cars, aka my favorite category, these are going to be the cars that are aimed at individuals who has already established some sort of history with using a credit card. They are known for their reward points or cash back, so their reward structure, their reward programs. They're typically tailored towards everyday spending. So, the things that we literally buy every month, they are for the everyday shopper. Those cards are tailored towards the everyday American. Uh, you don't have to be a high spender, right? To have those cards. Just literally are the things that we purchase every day is usually the categories in which they reward us in, like grocery shopping, gas, and things of that nature. Those are the perfect cards to grow. The growth ceiling is usually great. Like, those cars can get up to like 60,000, some of them. um and they grow, they have high growth potential. Again, they are my favorite cards. They typically have either no annual fee or a small annual fee. The cards with an annual fee in the mid-tier section, they will always have some sort of rewards, some sort of benefits to that card that outweighs the annual fee. It's stiff competition in that lane. So seldom will you see, oh, I thought that was a storm. Seldom will you see a company advertising a card with an annual fee and they don't have the benefits to to um to make it make sense, honestly. Like, they're not gonna come with the BS, because that's probably like the most competitive category, because there are so many options. And even the list that I showed you, there are so many more options out there. Those were just like my favorites, the ones that I have experience with working with credit cousins going to. So yeah, the list isn't comprehensive at all. And then top tier cars, those are going to be like your specialty cars, like most hotel cards, most flight cards, most specialty cars. So they're typically like for a particular entity, store, or category. They have great rewards, like the mid-tier section, and some would even say that they have the best reward structures, because they'll typically give you more points, and have definitely have more benefits for sure, right? But seldom will you find a top tier car without a high annual fee. For example, the American Express Platinum annual fee is $695. The Chase Reserve, I have a car, I don't even know what it's called, but I believe it's a Reserve. They just changed the name. But anyways, their top tier car annual fee is like $600. So it is expensive, but the benefits outweigh whatever the annual fee is. You just have to, if you get a top tier car, ensure that you are getting it for a reason and not just getting it because it's a top tier card. If you don't use the card in a way that it's intended to be used, then that card is going to use you because those aren't the cars that you typically will carry a balance on either. Not the top tier cars. They're usually built for you to recycle the balance, for you to continue to pay off the balance month after month. And then invitation only for presentation purposes. These are going to be the cars that you have to be invited to. Okay, so yeah, I don't be wanting to waste my time on invitation. Um, so I like to just include a little screenshotable wrap up to every section. But so for intermediate borrowers, try to look for targeted offers and pre-approvals, as I stated, so that you can generate a soft pull as opposed to a hard pull when you are obtaining credit cards. Try not to open more than 3 credit cards in a single calendar year. At that point, it is excessive to lenders, and now you starting to look risky to them. You don't want that. Consider a credit union. That's a big one, guys. Credit unions are the best for any level, honestly. Credit union and credit cards has the lowest interest rates. they typically are more understanding. They'll typically approve you for more out the door than like the big banks. It is really good. I always recommend that everyone has a relationship with a credit union. Whether you are I love them for their loans as well, because again, the lowest interest rates, the best approval terms. Credit unions are amazing. I would always recommend that alongside having, a relationship with a big bank, definitely look into your local credit unions. Look into your local credit unions. I kid you not. They are usually like really good. And then leverage bank relationships. So making sure that like if the institution offers a checking and a savings, open one. American Express offers a checking and savings now, guys. They even came out, the CEO came out. I couldn't even find a quote. Well, I only looked for it for like 5 minutes. I'm sure if I actually look, I can find it. But the CEO, um, maybe it wasn't a CEO, but it was somebody in the executive office. Um, said literally that they prioritize, they prefer, um, and they give priority to in more favorable terms to the people who hold Amex savings and checkings account, right? And that's not anything new. Like we've known this for a while, but it was interesting seeing them outright say it. It was interesting seeing them outright say it, especially because American Express's checking and saving account is fairly new. But they said this, within the last couple of months, and they were saying that, as they roll out these new accounts and make it available for everyone, they will prioritize that. So we're still in that period where they have already said that's who they prioritize. That's who they give the best terms to. That's who they give the best limits and all of that to, the approval terms. So just FYI, try to open up a checking and a savings account with the banks that you want to do business with. To do business with, especially if they have like if they offer personal credit and business credit, like nothing's better. American Express, for example, Chase, for example, open up a checking and a savings and fund it $10, and have it open for at least, usually with them they're a little more prestigious, so they typically will require you to have it open for like 90 days before you get the benefits. But I would open them. I would personally recommend that. All right. Yeah, we already at an hour. Okay, we almost done. All right. So now maintaining. Now we know how to obtain them. Now we know what to do prior to applying for a credit card. But let's talk about maintaining. This is a section, a scoop of the not the credit repair process, the credit building process that um I myself have felt grievance because I don't feel like I spend enough time on this, right? And that's something that I noticed about myself within the last year as I was looking over like all of the webinars that I've done. I'm like, okay, I focus on it a little bit, but I don't know if I put enough emphasis on it. And that's the meat. That's the meat of it, right? Like that's after you get the card, after you're approved for the card, what now? Right? Like, yeah, you can help people repair their credit and build their credit profile so that they can obtain these cards. But like, are you teaching proper stewardship of those cards? Because that makes a difference in that makes a difference for not only their present but also like their future accounts. So I had to include this for sure. Now, maintaining, one of the biggest pieces of advice that I would give is discussing like the transaction quantity, right? Just optimizing your transactions that you use on your credit cards. And maybe if you're not aware of what this is, so when it comes to our open credit cards that we have gotten approved for, you had the credit profile to be approved for that card. Maybe you even obtained a great limit that you were like, wow, I can't believe I was approved for this credit card. How do you maintain it? Not just maintain it, but how do you grow? Right? Like if you are getting approved for these cards, I would assume that you want them to grow. So this is something called the transaction optimization. The number of transactions that you do or you conduct within a billing cycle on your credit cards. There is actually a report basically being built about you over time. So the more time that you have a credit card open and the more time you spend with a company, there is a secret, or it's not secret, but it's just like a report in the background that always is constantly attached to your credit profile. And this is called the profitability indicator. Okay. So the number of transactions matter far more than people realize. I promise you, credit algorithms will view your transaction frequency, and then they'll basically attempt to guess like what is the profitability indicator assigned to you as a consumer. Not only do they keep keep these records in house, but they also sell it to their homeboys and their homegirls. Like I'm telling you, like other companies. The sweet spot is between 5 to 7 transactions per month. And these are for primary cards. These are for I would conduct all cards like this, but this was only tested on like the top tier cards. But I always say if you treat the lower tier cards the same way as you treat the top tier cards, then you'll just get to the top tier faster. I believe that. Now that 5 to 7 transaction is an average. That was based on studies. The next slide, I'm going to get a little more specific in that because I have noticed a difference. Or it is just a different amount that I would recommend to you guys if you want to grow your credit limits. Okay. Now for the cards that you want to keep active, but maybe you don't use them monthly, maybe they're old cards with $200 limits, maybe you've gotten approved for a higher limit credit card, a better credit card with rewards, and you don't use that card anymore. I love to use the subscription rotation method, right? And what that is you assign a small reoccurring subscription, so Netflix, Hulu, Apple Music, Disney Plus, whatever, Spotify, any subscription that you have, assign them to your credit cards. There is nothing better to lenders to a credit card company than seeing that you have subscriptions on their credit cards. They love reoccurring charges under all circumstances. They love reoccurring charges. I cannot stress that enough. Especially if you are in the market for getting a credit limit increase, please make sure that you place at least two subscriptions on not only your inactive cards. So yes, the inactive cards, keep a subscription on them because it'll keep them active without it closing. So you don't have to worry about it closing. And if you switch the transactions about every 6 months, then that's called the subscription rotation. So it never idles out. And you don't have to like really worry about spending on that card, using that card in order to keep it open. Because as you guys know, the number one reason for a credit card company closing a credit card is due to inactivity. So if they don't see that you're using the card, then they're going to close it eventually. They're going to close it. It just is what it is. Um, so you beat that by just putting a subscription on there. I want everyone, if you have an iPhone, and I'm sure Android can do this as well. But look at how many subscriptions that you currently have attached to your iPhone or coming out of your bank account, right? Every subscription that's coming directly from your bank account, I need you to assign that to credit cards. You don't get any benefit from having subscriptions coming out of your bank account at all. It's just it literally doesn't benefit you in any way, right? However, if you use those same subscriptions, so you're not spending extra money, but you use those same subscriptions and put them on credit cards, then you are benefiting because your lender loves that. So when you go to apply for a credit limit increase, one of those application algorithm green flags or red flags, a green flag is, do you have reoccurring expenses? Do you have reoccurring charges on this credit card? Yes. Awesome. So now they see, okay, this person uses this card. We can predictability. We can predict that they're going to use the card next month because they have a subscription on it, right? Therefore, we can trust that this card is still going to be open next month based on the history, and we're comfortable lending this person more money, increasing their credit limit. Okay. So that's just a small little hack. Put subscriptions on your credit cards. They should not be coming out of your bank account. That's just a switch. That takes 5 minutes or whatever. I don't know how long, maybe like 10 minutes, but it is so worth it. It is so worth it. Um, Avoid the common mistake, which I am guilty of this, especially in the beginning when I started getting approved. When I got my first instant approval as I was improving my credit, I was so excited and so thirsty that I was just applying for anything. I was applying for, if I knew that I had even a smidget of a chance of getting approved, it was like a rush. I would just apply because I just was used to getting denied. So I'm like, whoa, I'm getting automatic approvals. Like, oh, I am really coming up in the credit world, right? And it was just super exciting to me. So I just started opening um all types of credit cards. namely retail cards. And actually, that wasn't even a retail point, but I do mention that in the presentation. But avoid opening unnecessary cards. If you know you don't go to Lane Bryant, or I don't know, name the store. If you don't typically shop there on a normal basis, then there is no reason for you to have a credit card for that store. Um, I don't want to get ahead of myself because I believe that's on the next slide. But yeah, don't get cards that you know you don't use. That's so pointless. It does nothing for your credit profile. And avoid the unnecessary um there's a part of, I don't want to say every builder's journey, but a lot of people, there's a part of the journey where you'll notice that you are just like stuck. Stuck in a sense of stuck at a certain level of credit. And I know you guys can relate to this because you guys ask about it all the time. And I also have personal experience with it. You get stuck where it's like, okay, I'm improving my credit profile, maybe even getting deletions. I have credit cards now. I'm being responsible with them, all of the thing, doing all the things. But you find yourself not being able to get approved over a certain amount. And I usually see that it's usually like you can't get over that 10K hump. Maybe all of your credit cards is like between that $2,500 to like 10K. It's just like, I don't know why. It's just usually that level, give or take. But you get stuck on that level, and 9 times out of 10, 9.9 times out of 10, guys, the reason for that is because you probably have started to build credit too fast. The amount of accounts that you've opened within the last 2 years, it's probably been too many. So now yes, you are improving your credit and all of that, but now you are starting to, though you are improving your credit, your borrowing power, you are starting to drift into the risky level, because now you're overextending yourself. Now you are looking too eager to build credit. And now that is a red flag to lenders. So now they like, oh, whoa, why is this person opening up so many accounts right now? What is this the zealousness to like open up all of these accounts? Like, do we have to worry about impending doom? Like, are they in financial trouble? What's going on? Right? Because a responsible borrower just would not do that. And they know that. They've studied our spending habits over literally decades, right? So it's not usual for a responsible borrower to open up, again, I always tell you guys, more than 3 accounts in a year. It's too much. Because now you just start to get risky. Even if you're not doing anything, even if your credit profile is, I mean, even if your credit score is improving, it does affect your borrowing power. Listen, after you start repairing your credit, let go of the ideal of a credit score. You really just have to let go of your credit score and understand that, okay, after you start repairing your credit score only matters if your score is bad. Your credit score only matters if you have bad credit, guys. So after you start improving your credit, your score goes out of the door. And what matters way more is your profile. How are you, not only if you're building credit, how are you building credit? What is the method in which you're using to build credit? Now, what is the credit that you've been building? What does that say about you as a borrower? Because no, we're not going to just judge you on your credit score. That's low hanging fruit, right? We're going to judge you on how you build, not only build credit, but how you are maintaining. Again, this maintaining section is the most important part. I tell people all the time, listen, it is harder. It is harder. It is harder to maintain good credit than it is to build good credit. And that sounds crazy to a lot of people, but why it's so hard is because you're in foreign land. In the beginning, you're in foreign land. So you are now starting to be approved for things that you've never been approved for. So once you get approved for them, you have to learn the game. You have to learn the game, or you'll get played, or you will get in above your head. And now, you look up a year later or whatever the case may be, and now you're overextended. Now your borrowing power is worse than it was before you started building credit, because you've just been applying for any and everything that you would be approved for. Um, it happens to a lot of us. It happened to me. Like, I remember I was just like, oh my God, I had, if I can remember correctly, like 21 credit cards. 21 credit cards, literally. I don't know if you guys remember, but there was like a I don't know if you want to call it I forgot what it was called, the shopping cart trick? It was like a phenomenon going around within, like, the credit card company or the credit industry, the credit company the credit, industry, right? And it was like a thing called the shopping cart trick where you would literally get approved for, like, 10 community bank retail cards, and they were for, like, different stores in the mall, like Victoria's Secret, um, and name about 10 other stores in the mall, it don't even matter. But you would literally get approved for all of them off of one inquiry, but you would have to, like, apply within, like, 48 hours. So obviously, I get approved for my first one, and I just went crazy. I just went crazy. I had credit cards open for stores that I hadn't shopped at in years. I had Children's Place, Victoria's Secrets, Bath and Body Works. Like, it was so stupid. Um, but doing that really, really, really messed me up for a long bit. I eventually closed those cards because they just are low level cards. Like, and lenders know that, right? So too many of those, it just makes you look bad anyway. Okay, now, so remember I was telling you guys about the transaction limit. Now, the average per the CFPB studies that most lenders recommend, and they surveyed all of, I think they said like the top 150 companies, right? And what they found is the average amount of transactions per month that they would consider like good is between 5 and 7. That's the average, right? We don't do average over here, okay? We ain't average. We're not average. However, this is what I have been these numbers rather that is before you today. Like, these are from personal studies, right? So I'm not trumping what the CFPB said, because yes, that is average. What I have personally found is these specific transactions per month absolutely helps if your goal is a credit limit increase. If you just want to maintain your credit card and make your lenders happy, then maybe get like a yearly increase, the 5 to 7 is fine. So don't force yourself on these. They're not that big of a difference, but like, don't force yourself on these numbers and bind yourself to these when you don't have to. Okay. Now, this is what I would personally recommend. If you have a credit limit between $100 and $500, I would recommend that you have at least 5 transactions per month, aka per billing cycle, for that card. If again, your goal is to get a credit limit increase, okay? If the credit limit is between 500 and 1500, then I would increase those transactions to at least 7 a month. Specifically, before you apply for a credit limit increase, you have to do this 3 billing cycles in advance. So you have to do it for at least 90 days so that they can you can literally reestablish your average transaction limit. Whenever we apply for a credit limit increase, the bank that we are with, what they do is they survey specifically the last 90 days. Okay, how many transactions has this person averaged for the last 3 billing cycles? What is the utilization that they've reported? Like, starting to get a better picture of like your spending habits, what you need, etc. Right? And so if they see that you've maintained a lot of transactions per month and you use the card and you're trustworthy, then they will use that information in order to increase your credit limit to see how much more you could potentially need or you could use, right? Now, if your credit limit is between 1500 and 5000, I would recommend at least 13 transactions. Now, this is probably when I usually get the most like, whoa, that's a lot. I don't know how y'all spend your credit cards. I'm gonna be honest, I live off my credit cards, right? It is rare that my debit card ever sees the light of day, like to the point where this was recent. I went to a ATM and I couldn't even get cash out because I didn't remember my PIN. Because I never use my debit card ever. It has to be it has to be like a place like cash only type of thing. I never use it. Um when I say I live off my credit cards, I just mean that I use it for all of my everyday expenses because I want points for every time I swipe a card. If I want points for every dollar that come out of my bank account, I just feel like I deserve points. I don't know about you, but I like flying for free. I like going to like concerts and recently was third row at an NBA game, all off points. All listen, I ball off points. Unapologetically, I don't care, right? And I would recommend you do it too, because you if you realize how much money you spend a month on casual things like gas, like groceries high as heck. If you start using your credit card in place of your debit card, you'll hit these limits fairly fast. Like, you'll hit them fast, but don't do it unless you know you're gonna pay it back. Okay. You used your venture 16 months this time. Did I overdo? No, no, no. So no, you didn't overdo it. That's a good question. So again, these are just for people who maybe don't use their credit cards a lot. I certainly use my credit cards way more than these. But these are just like if you want to increase. You can't there's no such thing as using your credit card too much, with the exception of you just have an inability to pay them back. So as long as you are routinely paying them back, reporting a low interest, or I keep saying low interest, Lord, reporting a low utilization, then you are good. You literally can if it's 100 transactions in that month, do you? Long as you pay it back. Long as you pay it back, okay? If your credit limit is between 5,000 and 10,000 plus, so or more, committing to at least 15 transactions per billing cycle for the next 3 months before you ask for a credit limit increase, or just in general. Now, I also want to say that if you think that this is a lot or find yourself like, I don't, I'm kind of scared to commit to that, right? What I would challenge you to do, or number one, I want you to understand that every transaction counts. I tell this story all the time, but there has been times, especially like in the beginning, when I had like a $500 credit card, right? And I'm just sitting at the checkout line ringing gum. Well, it was like the limit is usually like $3 to $5. So I would like get gum, get a bag of chips, or get a 7-Eleven cup, a Slurpee, right? And I would do separate transactions. And especially if I looked up and my billing cycle was about to end and I knew that I didn't get my I didn't meet my transaction limit. Oh, I would be sitting there swiping. I don't care if the cashier has to literally ring me out 3 or 4 times. I'm going to meet my transaction limit. But again, this is for only if you like desire an increase, okay? So if you just, casually maintaining or whatever the case may be, then that 5 to 7 number is perfectly fine. It's perfectly fine. Your bank is probably going to go ahead and give you an increase. um they typically do reviews like once a year, and you usually qualify for at least the minimum level of increase by doing that 5 to 7. Okay. So then step 2 of maintaining, or is really no step, but another aspect of maintaining your credit card is learning how to pay your credit card bill correctly. And when I say correctly, not that this is the only way to pay your credit card bill. This is just, in my personal opinion, the best way to pay your credit card bills. To pay your credit card bills. And I don't know about you guys, but I am a person that I hate 2 things. I do not like paying any anything extra. I hate paying interest. Like, it is just something that I hate. Unless unless I have to, then I'll pay it. But if I can avoid it, I want to avoid it. And I would I would honestly recommend that you avoid paying interest on credit cards, especially right now. Credit card interest rates are the highest that they have ever been, not only in our lifetime, but since credit cards came out, literally. Credit card interest rates are the highest that they have ever been ever. Um and a lot of times, child, the interest is what gets people in a hole way more than the balance. Like, it's the interest. The interest adds up so quickly, and it could truly become like a down spiral. So that's the obviously more dramatic reason. But honestly, the reason is I don't like paying extra money. I hate paying any fees, any extra penny than I have to. I really do. Um Now, this is really for, honestly, this is for you guys to screenshot, but I wanted, because I'm a visual learner and teacher, so I wanted to show you guys as well. But here are pretty much like the 4 main principles to paying your credit card. And if it does not make sense on this slide, do not worry. I have an example. So, number 1, you need to identify your due date. You need to identify your due date, and then you need to identify your statement date. Every single credit card has a due date, and every single credit card has a statement date. These are going to be different based on your credit card. So if you have 5 credit cards, it is your responsibility as a consumer to know when your due date is and when your statement date is. Okay. Then once you've identified both of those dates, then if you pay, as long as you pay your statement balance by your due date, then you will not be charged interest. Your credit card company cannot legally charge you any interest, not even a penny, on any balance. Or I'm sorry, let me reword that. Your credit card company, your bank, cannot can only charge you interest on balances that you carry over past your due date. So if you always get in the habit of taking care of your full statement balance by your due date, then you will not pay interest. Okay. Now, your statement date is super important because your statement date determines the reported utilization to the credit bureaus. And I don't want to get ahead of myself because I'm going to show you guys this. But for right now, just to make sure that we all are on the same page, all I need you to worry about on this slide is you are responsible for identifying your due date, and then you are responsible for identifying your statement date. And yes, those are two different dates. And yes, every single credit card will differ. Okay. Okay. Where to find these dates? Like where can you look? What can you do? So number one, you can look. My favorite way is to just look at your most recent credit card statement. Okay. Or any credit card statement. You can either look at your credit card statement. Some banks, depending, like Capital One does this, and I believe American Express. But if you log into like the banking app, like your online banking account, your online account, they will explicitly say like, "Here's your statement date. Like your statement date is this." Um, Now the easiest way to find it again is to just pull your statement. Your statement date is the last day of your billing cycle. Okay. Your statement date is the last day of your billing cycle. So as you can see on the screen where it says billing period, that this billing period, this particular example goes from February 22nd, that's the first day of the billing cycle, and then it goes all the way through to March 21st. That's the last day of the billing cycle. So that will make March 21st the statement date because it is the day that the billing cycle closes. It's the last day of the billing cycle, okay? And then your due date, we most of the time I don't typically have to walk people through how to find their due date because that's like the most apparent date on a credit card. It is your due date is important because you have to ensure that you make a payment for at least your minimum payment, your minimal acceptable payment, which is outlined by your bank, right? As long as you make your minimum payment by your due date, then you will avoid having a late payment report to the credit bureaus. Okay. So, while I don't recommend that you only pay the minimum payment, if you have to by any means, it's better to pay the minimum payment than to not make a payment at all. So, as long your due date is important because it determines if you will have a on-time payment reported to the credit bureaus or a late payment potentially reported to the credit bureaus. The due date is also important because it determines it. So how I like to explain it is your statement date is for the credit bureaus, and then your due date is for your bank, right? Why do I say that? Your statement date again is the last day of that billing cycle. So on the last day of your billing cycle, aka your statement date, what happens is your bank will print out two statements. They'll print out one statement and then they'll send it in the mail to you. By law, we are the banks are required to send us a credit card statement every single month that outlines what our balance was on our statement date, so what our balance was ending that billing cycle, and also the minimum payment that they'll accept and the due date, right? So they have to, and also our transaction history. So what happened during this billing cycle? What did I spend? Where was my card swiped? By law, they have to send us a statement every single month. That statement is generated on our statement date. But also, what happens is on our statement date, as they're generating the statement to send us, they also generate a statement to send the credit bureaus. So they'll send the credit bureaus. They don't get your full transaction history and all of that. They don't care about that. All they care about is what is the balance when your billing cycle ended, because that balance, whatever your balance was when your billing cycle ended, that is going to be used as your utilization for the next 30 days. So, or until your next statement reports to them, until they receive another update on that credit card, which is your next statement date. Okay. So, statement date marks the end of the billing cycle. That current billing cycle is closed to any further transactions or payments. So, that's important to remember because anything that's pending, whether that's a transaction or a payment, any pending payments or pending transactions, if it is not posted by your statement date, then it automatically will go on your next billing cycle. Okay. That's so important to remember, right? Because again, if you are wanting to meet your transaction limit, only posted transactions count. If it's pending, it automatically goes to the next billing cycle. Most companies will cut it off at like midnight. So at 12:01, your statements are already generated. It's already generated, and they electronically will already send it to, whatever. The point is the statement is already generated. So you want to do everything while your statement date is important. You want to do everything at least two days before your statement date, because you don't want to have any pending payments that's not going to count for this current cycle, nor do you want to have any pending transactions because it's not going to count for this cycle, right? So make sure that there's always like a buffer, a 2 to 3 day, a 2 to 3 business day buffer between any payments that you wish to go on this statement in this billing cycle. Again, your due date, the deadline to make at least your minimum payment to avoid late fees and negative credit reporting. So again, your due date is for your bank. Your statement date is for your credit report. It is for the credit bureaus. So as you guys remember, I said that I'm a person, I hate paying interest. And the second thing that I hate most about credit cards, or I guess love, hate, I hate high utilization, right? I don't like when I don't like the damage that high utilization does to my credit profile, right? Therefore, I'm going to ensure that whatever utilization is reported to the credit bureaus, or in other words, whatever utilization is reporting on my statement date, I'm going to make sure that it's under 10% of whatever my credit card limit is. I don't care if a week before my statement date, the credit card was maxed out. I don't care. You just got to know that by my statement date, by the time my billing cycle close, come hell or high water, I am going to make sure that my balance is under 10% of whatever the limit on that particular credit card is. Simply because I want to make sure that they report a low utilization to the credit bureaus. I don't want a high utilization to affect any of my current credit cards or anything that I currently have going on. Nor do I want it to prevent me from receiving a credit limit increase in the future. I want to look good on paper. I want to look good in black and white. And in order to look good in black and white on our credit cards, we have to make sure that our statement date is priority, because that is what affects your credit report. That is what affects how many utilization points you are receiving every single month. The utilization that you report monthly literally will change, can, and has the power to change your credit score every single month. So you want to, for the most part, ensure that you are reporting a low utilization consistently. And the only way to do that is to ensure that the balance on your statement date is low. And my personal recommendation for low is between 1 and 10%. Now, your statement date is before your due date. And I'm getting a little ahead of myself, but your statement date is before your due date. This is important because by the time you make your payment for your statement date, unless you want to make additional payments, to avoid paying, the interest come your due date, you don't actually have to make any more payments, because if you when you pay your statement balance, 99% of the time you already are meeting your minimum payment. It's obviously before your due date. Therefore, you've already met the minimum payment. So you're not going to get a late payment. So the only additional payment you need to make after your statement date would depend on how much more, like how much leftover balance you have, right? Because I typically report a very low utilization, you typically like between like 1 and 3%. I'll either make a separate payment after my statement date on rare occasions, like, maybe there's a few dollars or whatever remaining, and I'll kind of just pay that off, but there has been times where I have accidentally not paid it off, and it's not the end of the world. um I'll answer that in just a second because I put it on the slide. Now, this is pretty much everything I just said, but I like to type everything out so you guys can remember it. And explain things very casually, but I want you guys, it's super important. Your statement date, again, that impacts your credit score and your utilization. So that directly impacts how many points you are receiving that month. This is so important. Your statement date is, dare I say, more important than your due date. I'm not gonna hold you. I care about my statement date. Like, I have my statement dates marked in my calendars, and I don't even have my due dates marked in my calendar. I don't mess up my credit score that I've been building for all these years. Now, your statement date impacts your credit score and your utilization. And that's again, your statement date is when your monthly statement is generated. So snapshot is taken, the balance is this, send it to you as a consumer, send it to the credit bureaus. This is what this person carried over. Any balance remaining on this date will be used to calculate your utilization, as I stated, which directly affects your credit score. If you want low utilization, which is considered to be between 1 and 9%, you must pay down your balance before this date. So the lower your balance is on your statement date, the lower your utilization is going to be to the bureaus on your credit report, rather, because not necessarily to the bureau, it's just on your credit report. Transactions or payments made after this date will appear on the next billing cycle, and that includes pending. Most banks will take about 1 to 2 business days to process any payments or transactions. With the exception of like Apple, like the Apple Card, they do same day posting. Some banks do it, but I even with the Apple Card, I still 2 days prior, I make sure I make a payment just in case. I don't know if it's gonna be a system error. I don't know. I would suggest that you just get in the habit of making your final statement payment 2 to 3 days in advance, just in case, okay? Now, the statement date is best for improving your credit score. So if your goal is to improve your credit score, you don't mind paying a few dollars in interest, which that doesn't hurt your bank, that doesn't hurt the relationship with your bank. They actually prefer you to pay a little bit of interest. I'm not gonna hold you. Like every once in a while, I'll allow a few about like 1 to 3% to like carry over past my due date, just so I can pay them their little few dollars, so they can continue to want to give me increases, because it is a for profit business. Banks are in it to make money. So if they see that they're not making any money off of you, then they are less likely to give you an increase. So if I know I'm about to beg, if I know I want an increase, I'll let them get a few dollars of interest out of me. I won't make the extra payment by my due date, whatever. Um, so again, if your goal is to just improve your credit score, then your statement date is the most important. Make sure you master making your payments by your statement date. Then you will see a direct reflection in your credit score and in your credit profile. Your due date the is for your bank, so it's for you too, because it avoids late fees. So if you have not met at least the minimum payment by your due date, then your bank will automatically put a late fee on that account. So they can charge you a late fee the next day. If you haven't met at least your minimum balance, your minimum payment, then they can charge you a late fee. However, they can't report it to the credit bureau. So they can't report that you are late to the credit bureaus until you have surpassed 30 days past your due date. So if your due date is on, let's say, the 15th of the month, if your due date is on March 15th, they cannot report that payment late to the credit bureaus until April 16th. Okay. So you have to be at least a full billing cycle late in order for it to count as a late payment towards to the credit bureaus. However, they could still charge you late fees prior. They can still charge. So if you make a payment 2 weeks late, then yes, they can charge you a late fee, but no, they can't report it to the credit bureaus that you were late, right? Because you paid within that 30-day. It ain't a grace period because you're being charged. And it also affects your bank, your personal relationship with the bank. So when you ask for credit limit increases with them, then they'll obviously see that you have paid them late. So it's not a great habit, but it does. If worst case scenario, you have to make sure you make your payment within 30 days, because then it will not be reported to the credit bureaus. Okay. uh Now, if you do not pay at least a statement balance by your due date, then you'll be charged interest. I meant to say, because a lot of you guys are probably like, wait, what? So our credit card billing, our credit card statements, we are billed retroactively, right? So it is March 12th. Let's say I got a statement in the mail today. I'm not going to be paying for March. I'm going to be paying for whatever I did in February, right? So the statement balance that's on my February statement that's due in March, that balance is reflective of last month's activity. So as long as I make sure that I pay the statement balance on my most recent credit card statement, then I will not have to pay any interest. You don't you Because your bank don't charge you interest if it's still within the same billing cycle. If it's still with if you take care of whatever you spent in the same month, then they don't charge you interest. They only charge you interest. You have a 30-day grace period on all credit cards. This is why when I say like I live off my credit cards, but the most important thing is I make sure that I pay them back is simply because a golden rule for cards are as you could spend as much as you want on your credit card as long as you pay it back within the same billing cycle because they don't charge you interest on any charges within the same billing cycle. Okay. So any your statement balance that you are seeing on your credit card statement, that is from last month. It's directly reflecting whatever was reported to the credit bureaus last month, whatever's reporting as your utilization on your credit report. You can look at it. It's directly reflective of last month because again, we are billed retroactively. We are in March, but we're paying for February's charges, right? And in April, we're going to be paying for March's charges. Yeah. Um, so again, if you want to avoid interest, then make sure you pay whatever the statement balance is on your credit card statement by your due date, and then you will not pay any interest for the last billing cycle. And rinse and repeat. Um, yeah, I put the same thing twice. So again, if your goal is to avoid interest, then ensure that you pay your full statement balance by your due date. And if your goal is to improve your credit, then ensure that you reduce your balance to between 1 and 9% by your statement date. I do both. For the most part, I do both. Um, and I would definitely suggest that y'all do both too, because who likes to pay extra money? Now, I kind of went over this in the last slide, but I wanted to show you. So, like paying the right amount. When you get a credit card statement, as you can see I think that's y'all right. So to the right, you will see like a snapshot of a portion of a credit card statement of my credit card statement, right? And as you can see, the current balance, there's a current balance, there is a statement balance. Okay. I get this question all the time. Like, what is the difference between my current balance? What's my statement balance? And how do I know which one to pay? Okay. So I kind of just went over this, but just briefly to get into it a little more, your current balance is the total amount that you owe towards your credit card, which includes not only your statement balance, but also any pending payments and fees and transactions that has occurred since your last statement generated. Okay. So you typically will only see your current balance if you're logging into a live like bank account. Live bank account sounds crazy, but I'm just saying like if you are live watching your accounts, logging into your credit card company's banking app, then you'll be able to see your current balance. That's not necessarily just your statement balance. It's reflective of what your balance is as of today. So if since your last statement you have made payments, you have spent a little more, it's reflective of all of those. The pending charges that didn't go on your last statement, it's counted in your current balance. All of that. That's just like a live view, right? Like I kind of explained it like it's a live view. Whereas your statement balance, as I stated, that is from last month. That was what was reported to the credit bureaus. That's written in stone. That is what it was at the ending of your last billing cycle. And that's really the most important balance because that's the balance that you have to ensure, you want to ensure rather that you take care of by your upcoming due date, just to ensure that you're not paying interest on that. Okay. Oh, keep doing that. I did the same slide twice. Okay. Now, I hope this makes sense for you. I don't this slide for whatever reason, it took me way longer than I feel like it should, but I wanted to make it freaking make sense. Okay. So this is obviously a calendar shot, right? And as you can see, the start of our billing cycle is March 1st. And just for easeability, the start of our billing cycle is March 1st. And our billing cycle ends on March 31st. Okay. And then our statement date is on the 18th, and then our due date is on the 20th, right? So our billing cycle starts March 1st, it ends March 31st. And then our statement date is on the 18th of the month, and then our due date is on the 20th, right? So there's two payments that I will personally make. Now, the first payment that I will make a payment by March 15th. Why March 15th and the statement date is not until the 18th? Because remember, I want to make sure that at least 2 business days I'm making my payment. I'm getting my balance to wherever I want it to be on my statement date. Okay. And it's a weekend. So low key, I probably would have did the 14th, but for demonstration purposes, I'm gonna make sure that I make my first payment no by March 15th because my statement date is March 18th. Okay. And then as you can see, my due date is only 2 days after my statement date. So they are fairly close, right? So what I would then do if I left any bound, like let's just say by the 15th, I reduce my balance to 3%. I reduced my balance to 3% of whatever my credit limit was. So if I had $100 credit card, then I only left, that's not a good example. I'll use a $500 credit card. So, well, if I had a $300 credit card, um, and I left 10% on my credit card, that means that I left a balance of $30 on this credit card. Okay. So I have a $300 credit card. Um, and I wanted to reduce my balance to under 10%. So I left a $30 balance on this credit card by my first payment. So I just wanted to make sure that my utilization was below 10%. So I made however much I had to pay, like 200 some dollars, $270. And then I left a $30 balance to report on my statement date. Okay, cool. My statement date passed. The credit bureaus were updated that my utilization is 10% because I left $30 on the $300 credit card. And then because I don't want to pay interest this month, what I'm going to do is then make a second payment the day after my statement date. Okay. I'm gonna make it a day after my I'm gonna make it a day after my statement date because I do not want to pay interest. So I'll go ahead and take care of the rest of that $30. Actually, in this example, I use $500.50. Same difference, right? $500 credit card, left a $50 balance, that's 10% past my statement date. Then I made a second payment and I went on ahead and paid the remaining $50 that was the remaining balance, which was $50, so that I can avoid any interest. Okay. Does that make sense? Or do I need to explain it again? And then after my due date passes, so come the 21st, after March 20th, then I just continue to use my card as normal. What I typically like to do is right after my due date, I usually reserve all of my highest expenses towards the or like right after why did I put the ending of the billing cycle? I just realized I made a mistake on here. Shoot. Dang it, I made a mistake. My statement date is the billing cycle. Shoot. I don't know why I did that. That's crazy, but whatever. Act like y'all don't see that 31st. Anyways, NT ways, it just threw me off. Y'all probably are confused because I just realized I'm like, wait, what am I? Anyways, but the point is I do reserve my highest spending after my due date. So after I make sure that my statement date is good, my due date is good, all of my largest expenses I usually do like at the start of the billing cycle so that I have more time to like pay them off, all of that. Okay. So that's just a personal thing. I would recommend that you ensure that you try for the most part, if it makes sense for you and your budget and all of that, to do the bulk of your spending towards the beginning of the month, like your highest bills or whatever the case. Beginning of the month, so you have more time to pay them off. This always confuses me when explained because on my accounts, my statement dates are after. I guess I should have said that. So every it varies. It can't like there are some every credit card is different. So if yours is opposite, then it's still the same thing, right? Like so regardless of let me go back. Oh, keep doing it. Let's just say your hold on. Let's just say it was reversed. Let's just say your due date was the 18th and then your statement date was the 20th. uh you still want to make sure that you pay so if your due date is before your statement date, the only difference is you need to make sure that you do make your minimum payment by your due date. So regardless of if you plan to make multiple payments, you still have to meet at least your minimum by your due date. So if your due date is first, then make sure that you make at least your minimum payment, right, by your due date. And then what I would do is make an additional payment after my due date. If you don't go ahead and take care of it by your statement, I mean, let me start over because I don't want to confuse you. If this is opposite, if your due date is before your statement date, then you just want to make sure that you pay at least your minimum by your due date. If you don't want to take care of the full balance to avoid interest, then just make your minimum payment. But then before your statement date, depending on how close they are, I will make an additional payment to ensure that I reduce my balance to under 10% of whatever my credit card limit is. Okay. So regardless of if it's first or second, it really doesn't matter. You just have to know that, like, if your due date is first, make sure you make that payment by your due date so you're not charged any late fees. So you're not making your bank mad. You know what I'm saying? Make sure you make at least your minimum payment. Most people, if they have a due date that's first, what they'll do is they'll go ahead and either pay off the full balance, so reduce your balance to zero, and then if your statement date is right after, if it's 2 days later, then they'll just do a small transaction, a small charge, maybe like a, I don't know, gas or something like that. I don't know, depending on how much your limit is. Just spend on your credit card. Okay, I can definitely explain it again. I'm so glad y'all telling me as I'm going, because why did it go all the way back to the beginning? Because it's important for you guys to understand paying it, because that makes or breaks your credit card. Actually, one of the examples I put had a due date first. Okay, so look on this example, I wish I had my little thing on the screen, but on this example, if you look at the statement date, you will see that the statement date is June 7th, right? And then the due date is the 4th. So the due date is first. Now, what I would do is I would make my I would pay my full statement balance by my due date so that I don't have to pay any interest on $88.52. So I'll make that full payment, okay? And then my statement date is a few days later. So if I make that full payment, as long as hold on, I just confused myself. My bad. If I Because I was looking at the current balance, that's what threw me off. Okay, so the statement balance is $88.52. My due date is the 4th of the month. Okay. So I would pay the entire $88.52 by my due date because I don't want to pay interest. As you I don't want to pay interest, right? Then because my statement date is 3 days later, I would just go to the store and charge $15 or so on this card. Get some gas, get some goodies, and allow that transaction to post. So that come my statement date, the only balance on my credit card is going to be whatever that little gas station run, whatever that cost, right? I will make sure that I don't use my card except to make that small transactions just to avoid reporting a $0 utilization. Yeah. Stacy, great. Yeah. If your due date is first, just pay your balance in full on the due date. And then just don't use the card again until after your statement date. That's the easy way to do it. Especially if it's close. Like if they're only a few days apart, then I wouldn't stress myself out about like making 2, 3 payments. No, no, no. If it's like 2 or 3 days apart, your due date is first. Take care of that full balance so that you aren't paying interest. And if you want to make it, and if you want to, you can make a small charge. Buy something on Amazon. Well, that's probably not the best advice, but I'm just saying, like, buy something that's like $10. Amazon charges, not Amazon. Gas station, they usually post same day. Not if you pay at the pump, but like if you pay in the store, that's usually my little hack because they post same day. So I'll either go and get some chips or something. If you want to report a small balance to avoid reporting zero by your statement date, since you zeroed out your balance on your due date. You never want zero utilization. So not all across the board. And well, let me just answer this. Not if I want an increase on that credit card within the next few months. So there are some credit cards that I do report zero on. Credit cards that I really don't care about, care to grow, don't really use much. Then I don't care. I just do not what I never do is if I have already been reporting a zero utilization on like other credit cards throughout the month, I always have at least one credit card reporting at least like 2%. Because what you don't want is a zero across the board. Now, most credit cards, yeah. But I do typically like your main credit card that you use on a day-to-day basis. for me personally, that's the card that I routinely will carry at least like that 1 to 3% on. Just because, again, because my goal is to always get an increase. Um, I don't want to report a zero balance because then the banks and lenders will just say, okay, well, this person doesn't use the card enough, right? Or because of $0 utilization, a 0% utilization, it doesn't speak to how responsible you are when managing that credit card. You can either not be using a credit card. They don't know. A 0% doesn't tell them anything, because again, it could either be the credit card just closed, or the credit card or you just don't use it. A lot of people don't use their credit card. So 0% almost is to your detriment, especially if you are wanting to obtain more credit. You typically want to show, and also it can reduce your credit score as well. It can reduce it by a few points, but it definitely affects your borrowing power, your borrowing ability. We, as a borrower, you want to be a borrower on paper. You want to be a borrower, right? And the least expensive way to do that is to just report like a little 1 to 3%, just to show, yes, I do use this card, but as you can see, I'm extremely responsible in paying it back. There's usage on this card, so it's being used. However, I paid 99% of my charges back, which is what lenders just prefer. They don't want Lenders never want borrowers that they don't feel like use their card. They don't want that at all. So if your goal is to increase your credit limit and get future credit cards, especially at the time of the application, I would avoid reporting a 0% across the board. Just me personally. You could do one card, Dominique. You don't have to report a balance on every card. I definitely don't. I definitely don't. I really use like 2 cards for the most part on a day-to-day basis. And just on those 2, because again, I want increases, I'll leave like a 1 to 3%. But there has been months where I haven't left anything. So I this isn't this isn't ritual. Like it isn't ritualistic. Like I do it for the most part, but if I just don't, you know, catch it in time and not report a small balance, it's nothing. You know what I'm saying? It's not the end of the world unless I'm actively applying for something that next month. Now, and this also is going to answer the question as well, because this is what I was about to explain. The AZO method. That's the number one trick to like not only instantly boost your credit score, but also to make you look the best to borrowers. Without fail, anytime that I am actively applying for anything, I don't care if it's a loan, I don't care if it's a credit card, I will always do the AZO method. Some people just do this on a month to month basis, and that's awesome. It's just I don't sometimes remember to do it every month, but you can never fail by doing this. And this also answers a few of you guys' question. Um, AZO method, what is it? It is all zero except one. So what that means is if you have at least 3 credit cards, because unless you have 3 credit cards, this method isn't effective. So if you have at least 3 credit cards, the AZO method is reporting a $0 balance on all of your credit cards except one. And when I say report, I mean on your statement date and your due date. So go ahead and just pay off your full balance, allow 0% utilization to report. You're not paying interest. And that's it. You pay off your full credit card, right? However, you reserve one credit card, and you leave a small balance between 1 and 3% on just that one card. Okay. So again, you have at least 3 credit cards. You zero out the balance on, if the example is we're using 3 credit cards, we have 3 credit cards. We zero out the balance on 2 of them, completely zeroed out. We don't worry about leaving a balance at all. And then on one card, we leave a 1 to 3% balance. Then that is called the AZO method. What that does is that maximizes the points that you're given for credit card utilization, which is up to 165 points. So it only takes 3 billing cycles to do this consistently in order to pretty much max out those points. So if you know that this is so good for like loan installment based loans. I mean installment based scores. So every time I'm journeying with someone closing on a home, we do this. We never fail. We do this. Like it's required, literally. Um, a car, you will see the difference in your interest rate if you do this. 1,000%. If you can get at least 90 days before you apply for that home, that car, and obviously do this for at least 90 days, so 3 billing cycles, you will see a difference. It is like it when I tell you this, the AZO method affects every version of our credit score. So it doesn't matter if they're pulling TransUnion, it doesn't matter if they're pulling FICO 8, FICO 9, FICO 10. Every credit score favors the AZO method. The only difference is, I mean, the only thing is you do have to have at least 3 credit cards. Okay. So again, all zero except one. Even if you have 20 credit cards, zero out 19 of them and then leave a small balance on one, just one. And when I say small balance, I'm talking between 1% and 3%. You do that, you are maximizing the points that we are given or allotted, that's allotted to us for credit utilization, which is again up to 165 points. That's the perfect thing to do before a credit limit application. I mean, a credit limit increase application. In all. Oh my goodness, we're at 2 hours. No. Okay, let me. All right. I'll talk about this a lot. So hopefully we can zoom through this. I think this is the last one. Okay. Credit utilization. What is credit utilization? It is it is the balance that you're currently using versus your total limit. Credit utilization is calculated in two different ways. It's calculated individually, so per card, and also in aggregate. So overall. Okay. You guys will get the slides and all of that, as well as a workbook. The most important thing that I wanted to talk about is the utilization thresholds. Hold on, yeah, my throat. Can we do that with having balances in the 30% and under? We will miss out on the points. Oh yeah, 30% is not good at all, especially if you're growing your credit score. Speaking of, this is what this slide is about. Actually, you need to get familiar with utilization thresholds. I beat this down you guys' throat, but it is for a very good reason, and it will make a night and day difference in your borrowing power. Everybody do me a favor and just screenshot this. It's gonna be in your workbook that you're gonna get this week, but for your phone, to keep it on your phone, just screenshot this. Screenshot this and get very well acquainted with these thresholds. Number one, what are utilization thresholds? So, utilization thresholds are specific percentages, breakpoints that the credit scoring models use to evaluate how much of your available credit you're using. These thresholds are super important because they determine when your credit score starts to be penalized versus rewarded. It matters. These percentages matter. I like to refer to these as steps. So as steps or levels. Let's just say levels. Okay, cool. The best level to obviously be on is level 1, and that's between 1% and 3.9%. Notice I did not say 4, because the second that you hit 4%, then you've moved to level 2. 1, obviously, I should have said this. 1 is the best level, 7 is the most risky. The 7 is the level that penalizes your score most, and 7 is the level that you are losing most points. Most of the 165 points that were allotted for credit utilization at 11 at level 7, you are losing about 90% of them. At level 1, you are putting your credit profile in position to be gaining over 90% of them, if not 100, depending on what else you're doing on your credit profile. Okay, so that's the best position. If you want to increase your credit score, you need to understand these credit utilizations. Or I'm sorry, these utilization thresholds. Now, level 2 is between 4% and 8.9%. Okay. So again, I typically say, hey, just make sure that you report a utilization between 1 and or below 10%, or between 1 and 9%. That's simply because these first two levels are the best levels that you can be, but they're the ones that's going to earn you the most points. Earn you the most points. So if your goal is to increase your credit score as fast as possible, staying on the first two levels is going to do that. No other account type on our credit profile improves our score more than utilization, or I'm sorry, faster than utilization. None. There's no other category. There's no other account type. There's no loan. Even if you paid off a loan, there's no account type that improves your credit score as efficiently as a credit card. So it's super important to take advantage of these, especially in the beginning. It is just the fastest way to improve your score and your borrowing power. Okay. Now, you'll notice that at level 3, that's when it starts to get yellow, right? And you probably looking like, well, between 9 and 29%, that's still good. I typically do that on a day-to-day on a month-to-month basis. Well, I want you guys to know and realize that anything above 9% reported utilization, anything above 9% is not good. It's not even considered good to lenders, right? The industry standard is 30%. I know we've grown up and been taught to report a 30% utilization. Well, that's the average. I liken it to getting a C in school. Okay. So if you're in a class where let's just say you have a D in that class, and let's just say you have a D in that class and you don't want to fail for the semester. Is your goal going to be to get a C on the final? No, because chances are you're probably going to fail or be very close to it, right? That 30%, that C is going to just keep you stagnant. It's just going to keep you there, but it is not going to increase your position. Okay. So if you have bad credit, if you have no credit or bad credit, understand that when you report a 30%, that is literally you doing the bare minimum credit score wise, um, credit percentage wise for your credit score, meaning that you are only going to get the bare minimum amount of points. That's actually like, as you can see, level 4. Whenever you increase your credit, if your utilization is above 30%, that is considered high by 99.9% of lenders in the nation. And I don't even know who that 0.1% is, and that's according to CFPB. 30% is extremely high. The problem is, the problem is most people are so used to reporting the 30% because we're taught it, number one. But understand why our banks tell us to report 30%. It isn't for our good. It's because that 30% is low enough so that they're not taking that much of a risk, right? So if you report a 30% utilization, if you carry over uh 30% of your balance every single month, that's a low enough risk to where they still believe that you'll be able to continue to maintain this credit card without it getting out of hand. But also, that is an extremely comfortable rate where they are making a lot of money off you without taking that much of a risk. You report 30%, they making a lot of money off you. But it's not detrimental enough to where it's going to consume you in terms of interest. Yeah, you're going to be paying a lot of interest, but not like it's not earth shattering for most people, for the average American. So that's a very sneaky way for them to make a lot of money off you, for them to justify not giving you a credit limit increase, and for them not to have to worry about other competition, because they know that most companies, especially like the top tier companies, they're not going to approve you repeatedly reporting a 30%. And if they do approve you, it's not going to be for very much. So they don't have much competition. Okay. You're not going to be asking for much because you probably don't even realize that your usage that you routinely report is high. Lenders look at a 30% and literally it's a orange flag is raised. They're like, whoa, this too much, right? So again, if your goal is to improve your credit in 2025, if you're a credit cousin, if you're in Credit Academy, 30% is off the board. The goal is the first and second level. So keeping your utilization under 10% is the goal. That's where you are going to see your score increase. I'm talking by the next billing cycle. You don't gotta wait long for your credit score to increase using a credit card properly. In fact, if you are used to reporting a 30%, I'm going to challenge you for the next 2 months. I just want you to do it for 2 billing cycles. And just to see, just to test me, test it. I'm telling you, report a utilization. If you want the maximum points, report your utilization between 1 and 3%. Do it for 2 billing cycles. Make sure that you don't carry over more than 3% of your total credit limit. Do it twice in a row. And see, don't you see a big difference in your credit profile? See, don't you see a big difference the next time you apply for credit? Latasha. Oh, I see, Latasha. You said I took your advice earlier this year and did the 1 to 3%. What was the results? You cannot go wrong. Based on how our credit scores are broken down, based on how they are allotted, we are rewarded the most when we report a utilization between 1 and 3%. That's where you're rewarded the most. That's the best place to be on your credit cards. But level 2 is still great. You're still getting majority of the points. The difference between level 2 and 1 is like 15 points, which can be a lot, but I'm just saying, like, it's not night or day, right? But the second you get to level 3, that's over a 25-point difference. I don't know about you, but I can't afford to be missing 25 points. I don't care how high my score is. If a few percentage points will change $25, then I want every point I can get, right? Now, l- this is so important because yes, levels 1 through 4, cool and dandy. I want you to know that the second that you reach level 5, so if you are reporting a utilization on any individual card, because these are the thresholds are measured per card. If you have a credit card reporting a utilization of 40 of over 49%, that card to lenders is being weighted as maxed out. You every time you do a credit card application, you get the maxed out penalty. And what that means is the second that they see any individual credit card over 48%, your credit profile is automatically coupled with this person has a maxed out card. They use other words, but the point is it's called a maxed out penalty. They consider any credit card with a utilization reporting over 48.9% as maxed out. Crazy, right? Yes. So you reporting half of your utilization. I mean, you reporting half of your credit limit is used, maxed out. It's maxed out to most lenders, right? Um, and then it just gets worse and worse. So obviously between 49 and 68.9, maxed out, extreme, very risky. Between 69 and 88.9%, that's extremely risky. Like that's that territory. You are you are literally missing out on probably like 80% of the points that you can get. And then obviously above 100% or actually above 89 to 100% plus, that's off the charts. One more thing that I want to say about reporting 30%, if you've routinely been reporting 30%, we get 165 points allotted to us for credit utilization. I keep repeating that, right? If you routinely report 30%, you are only getting about 70 to 80 of those points. So you are leaving, literally just leaving about 80 to 90 points just on the table, just that you could get within one billing cycle, within 1 month, if you reduce your balance to under 10%. That's 80 points. That is the difference between having bad credit and good credit, even good credit and great credit. Like 80 points is a lot. That absolutely takes you down a credit rating, right? Who can use 80 points? I'm sure that, if you want to increase your credit score, your borrowing power, you can use 80 points. I can use 80 points. 80 points is a lot. So, again, routinely reporting at 30%, man, you are missing out on so many points. And I would just challenge you to reduce your utilization the next month by your next statement date and see the difference that it makes. It truly makes a night and day difference. Um, Now, real quick, you guys probably have already have this screenshot because I've this the same thing since diapers. This is the credit profile foundation that I have been recommending for years, and that's because it's tried and true. It works, and it's the perfect foundation. Regardless, I'm sorry, yeah, I thought my dog was choking. So, this credit profile helps with mortgage scores. It helps with credit card applications, loan applications. It doesn't matter what you are applying for. This credit profile translate across all scores. What is it? So, if you are just building credit, just establishing credit, or maybe you are a seasoned borrower and you've been building credit, but you find that your score is like stagnant, right? Again, I told you guys that a lot of times when our credit scores are stagnant, it's because of how we've built our credit profile. uh Building great credit is just as much as time as it is strategy, right? So make sure that you are checking off each of these boxes. Doesn't matter if you already have more accounts than what's on this list. Make sure that you are checking off these boxes, and if you are not, then you know what the goal is. Okay, so have at least 4 open accounts. Anytime our credit profiles drop below 4 open accounts, then our credit profile is considered thin. So we automatically on all of our applications are tagged with what's called the thin credit profile penalty. That just means that we're not going to be qualified for the top offers. We're not going to be qualified for what the experience profiles are qualified for. Automatically, doesn't matter what our score is. You can have an 800 score and have a thin credit profile, and you still aren't qualified for the best offers. Okay, because again, score doesn't matter. Okay. Of those 4 accounts, ensure that at least 2 of them are credit cards because you always want to have at least 2 credit cards open so that you are maximizing your credit utilization points, and you are able to efficiently report open accounts on your credit profile and build credit faster. Okay. So have 4 accounts, two of them have at least 4 accounts, two of them being credit cards. That third account, I would suggest that you get a long-term installment. A long-term installment is any installment over 36 months. So if you have a student loan already reporting on your credit report, then you have a long-term installment. You don't need to get another one. If you have a car loan, then you have a long-term installment. You don't need to get another one. Um, and whatever other types of loans that I'm missing, because a lot of loans qualify as long-term. The only qualifier is that the term length is over 36 months. Okay. Then it's a long-term installment. Now, that fourth account, I would personally suggest that you get a short-term installment. A short-term installment is the opposite of a long-term. So it's any loan that's under 36 months long. So this can be personal loans. This can be like furniture loans. This can be like self accounts. This can be credit builder loans. There are so many options. In the workbook that you guys will get this week, I've listed multiple options for all of these account types. Okay. All right. Now, the credit cards, as we've discussed in this presentation, ensure every month that you are reporting a utilization between 1 and 9%. So keeping your utilization under 10%. That's the goal. That's the goal because we want to get as many points as possible. Okay. So of these 4 accounts, two being credit cards, on those 2 credit cards, ensure that your utilization routinely and consistently is being reported between 1 and 9%. 1 and 3 if you fancy. If you just want every little point that you can get, 1 and 3% is always going to do you good. Um, and then if you are specifically like shopping for a home or a car, one extra boost that you can give your credit profile at any time is to have a loan, have any installment that's at least 90% paid off. So technically 91% paid off, meaning that there's a remaining balance of under 9%. Do not pay off the loan early, right? But if you have an open loan that's at least 91% satisfied, then you get a boost on all installment based scores. So that's just a trick that we do, like when someone is closing, when they're pursuing a mortgage loan, we do that last point. But that's you could do that. It affects any score, but specifically, like I stated, if you are going after any installment based loans, cars, homes, having at least one installment, 90% satisfied. Typically, I will use like that short term installment to do so, right? So this is just a great foundation. Even if you already have 20 credit cards, it doesn't matter, right? Make sure that you still have a short-term installment because it does make a difference on your credit profile. I have one CC and two bank accounts. So if I get another CC, will that count as four? Bank accounts don't count. It has to be accounts on your credit profile. So your bank accounts, they're not considered accounts like on your credit profile, right? Accounts are loans, credit cards, things like that. Oh, I should have waited. You know what? I don't wanna okay. Real quick. Freak. We ain't gonna be able to finish this whole thing. I'm gonna have to come back because we already had 2 hours. Okay, increasing. Screenshot this. Because I honestly talked about all of these in the presentation. But I like the little screenshotable material. So screenshot this. This is just easy ways to increase your credit limits. 6 months after opening every credit card, unless it's a subprime card, you need to be applying for an increase. Stop waiting for your bank. Actually, you know what? I'm going to do a bonus episode of Credit Bootcamp. Credit Bootcamp was technically supposed to end at 5, but I want to do a bonus episode about increasing our credit limits because I don't want to rush this part. And there's a lot of little nitbits and tricks and tips that I want to give you guys. Um, yeah, we on slide 23 and we got 41 slides. What was I thinking? So, so let's do credit limit increases tomorrow. Yeah, down for that? Because we'll be going for another 2 hours. Lord, I talk too much. Do you have a breakdown? Do you hold on? Do you have a breakdown like that for when trying to approve for a car loan? So I group car loans and home loans in the same category because they're installment based. they're installment based. They're installment based loans. My throat get to getting dry. Installment based loans. Actually, after credit boot camp for the VIP members, we're actually doing a home buyers master class. next month. So that can couple as also like a car. And we also have the one that I did last year. If you want to go ahead and watch it, it's already available in the group. Dominique, I did. Did you watch that week? Yeah, because I'm on it's 20 more slides. I don't even understand what else. Let me see what else I didn't put. Oh yeah. Okay. Yeah, because I also discussed recovery. So, like, what happens if you're denied? What can you do? What are the things that I do? Yeah, I don't want to rush those because those are important. Dang, I be coupling too much into one week. That be the problem. That be the problem. Yeah, so we already at 2 hours and we're already at 2 hours and 13 minutes. So we're going to focus on the last two sections, which are increasing as well as recovery. So when you are denied for credit, what happens? What do you do? Do you have any options? What are the ways that I have found to be profitable in the sense of getting approved for the credit card? What are the ways that some credit cousins have found favor in the recovery process? Okay. Yes, it'll be in a group like as this was, and it'll have another link. Okay. Yeah, and we also have a collections webinar in the group as well, Dominique. I would actually view that, although we are doing another variation of it, but it's still pretty much the same. So make sure you guys let me show you really quick before we get off. Really quickly. Hold on. Um okay, let me show you guys something really quick. I need to pull this. Screen share. Hold on, y'all. I gotta go to it. Okay. In case you guys haven't seen this. Okay, perfect. Let me share my screen. Screen share present. Is it showing? Okay, yeah. All right. So if you go to the replay vault, there are full length webinars that you guys can view at any time. This is the personal information webinar, how to challenge a bankruptcy webinar, plus the kit. And in case you don't know where to find a kit, if you scroll down, we link the kit right at the bottom. Okay. LexisNexis. We have the FICO 10T, which is the newest variation of our credit scores. We have hold on. We have where is it at? The eviction webinar, the eviction kit. That's just the eviction kit. The eviction webinar is in here. But yeah, and also I actually have a few more webinars that I need to upload. I just increased the bandwidth of the site so now that I can upload more. Because I know I have a repo webinars, 3 parts to that because that was extensive. But yeah, make sure you guys are visiting the replay vault, and also for credit bootcamp specifically, there's a whole room for credit bootcamp. Go back to watch week 1, download the workbook. Credit bootcamp comes with a workbook every week. So week 2, which we talked about credit reporting and personal information, there's a kit, personal information dispute kit. Then week 3, we talked charge offs and collections. But I see what whoever just asked about the collections. I I think we should add a collection to this. Yeah. But anyways, the charge off kit is available to download, and then week 4, the third party agencies, these are all available to download. Okay. So yeah, just FYI, these are available in the group. The replay vault available now for you to watch. And yeah, get all the information, get as much information as you possibly can. But yeah, so tomorrow we are going to discuss increasing your credit score. Increasing your credit limits and also like recovery. So we are going to do increasing in recovery tomorrow, okay? Because I put way too much in this one. And I really was convinced. Like I convinced myself that like it would only be an hour and 30 minutes. Like I was so convinced, but yeah. it's just not happening. I don't want to rush it. Okay. So I will see you guys tomorrow. This will be available for replay by tomorrow morning. You guys will be able to click the same link to replay this one. And then there will be a new link for tomorrow. It'll be in the events hub. Okay. I don't want to overwhelm you guys all in one night. I'm overwhelmed. My throat dang dry. Okay, so I don't want to push it too much, but that's okay because we coming back tomorrow. Okay, so get some rest. Maybe replay this, rewatch this, so everyone is on the same page. We're gonna hop right in tomorrow. Hoping, praying that tomorrow is not. I'm not keeping you guys for 2 hours. That's so OD to me. I be trying so hard. But I hope you guys learned something tonight. I hope it was beneficial for you. I hope it was worth your time. I enjoyed the time with you guys, and I can't wait to see you guys tomorrow. We'll be back tomorrow to finish off this webinar, okay? Or it'll be 4 hours, and that's too much. All right. Good night, guys. I will see you tomorrow.